Are you tired of chasing after the crowd and getting into stocks with no real plan? Start getting advice that works for you. Let Bud Rolfs, Chief Technical Analyst of the Tiger Trading Post at TFNN.com, be your personal guide through the jungle that is the market. Bud offers personalized and customizable programs for investors who are serious about making and saving money in the market. Find Bud Rolfs and the Tiger Trading Post under the advisory services at TFNN.com today and get the personalized investing advice you deserve.
Today's session is going to be called How I Use the ARMS Indicator. And for those of you who are in the den, you'll be able to see the slides I'm going to show. This is a little PowerPoint show to cover the topic. Any of you who are listening, if you want a copy of what I'm going to go over, all you have to do is write me at Tiger Trading Post at TFNN.com. I'll be happy to send you out a copy of what I'm going to cover today on the program this morning. How I Use the ARMS Indicator by Bud Rolfs, September 10th. All right, first of all, let's start out. What is the ARMS Indicator? I use the term all the time with you in the morning, and some of you are probably saying, you have no idea what I'm talking about. Perhaps think I don't have any idea what I'm talking about. But the ARMS indicator, or TRIN, was an indicator developed by Richard Arms back in 1967. And this term TRIN that you hear, T-R-I-N, is just the abbreviation, if you will, for trading index. This is the ARMS indicator is a short-term trading index, and of course the first two letters of trading in an index are T, R, and I-N, and that's how they get the term TRIN. Not a lot of science in that, huh? But anyway, that's called by either name, either the ARMS indicator or the TRIN, T-R-I-N. And as we said, this was developed in 1967, and it's an index that you calculate, okay? It's mathematical, and it's arrived at by dividing the advance decline ratio. That's the number of stocks that are advancing on the New York Stock Exchange divided by the number of stocks that are declining. Okay, that's the advance decline ratio, and you divide that by the volume of the advanced decline ratio. And what that means is we take the volume of the stocks that are moving up for the day and the volume of the stocks that are moving down. And we make a ratio of that. So you have a ratio of breadth, if you will, the advancers to the decliners, divided by the volume of the advancers to the decliners. So it's two fractional numbers, and they just do the mathematical calculation, and that's how you get the ARMS indicator. What's it do? What it does is it serves to help us identify conditions where the market is either short-term overbought or short-term oversold. That's what its function is. And on a single-day basis, if you do that little math that I talked about, if you get a number of about 1 where the advanced decline ratio divided by the advanced decline volume ratio is about 1, that's a neutral result. And that means the market, whatever it's doing, can keep doing it because it's about 1. If you get a number less than 1, that indicates a degree of overboughtness. And the more that you're less than 1 on that ratio, the more overbought that day was. Okay, and then if you get a number bigger than 1, that would indicate a degree of oversoldness. And the higher above 1 you are, the more oversold that particular day was. So 1 is kind of neutral. Less than 1 tells us we're overbought. Greater than 1 tells us we're oversold. Now, we don't take any single day. We can take individual days and do some things with them, and I'm not going to go into too much of that today. But on what we do is we total these single day readings, and we do it either on a 5 or a 10-day basis. And if you take a 5-day basis, neutral, we said neutral on a single day was 1. So if you get a total after 5 days of around 5, that's neutral. If, on the other hand, because a big number means we're oversold, if you get a 5-day total that's greater than 6, that's telling you that the market is short-term oversold. If, however, you had 5 days and they total out to be 4.5 or less, that means that you had 5 days where either they were so low they overrode it, or individually they were less than 1 every one of those 5 days. You might have had one in there that was a little higher than 1, but the total of the 5 came out to be 4.5 or less. That's telling you that you're overbought. Okay, so 4.5 on a 5-day total is overbought, and neutral is 5, and oversold is 6 or greater. Now let me give you a couple of examples. Here we have an example of a strong up day. And on this day, the New York Stock Exchange, in this example that I have ginned up here, this example, the number of advances, and in this assumption we're saying that the New York Stock Exchange has about 3,000 stocks. So you had 1,900 that advanced in this particular day and 1,100 that declined. Okay? So the ratio of advancers to decliners is 1.7. So we calculate that number and we set it aside. Now to do the lower number, we take the volume, the number of those stocks that advanced, that closed higher for the day. Their volume was 1.4 billion shares. And of the stocks that declined, their volume was 600 million. So in this little example, you came up with 1.4 billion divided by 600 million equals 2.3. So what you do is you divide the 1.7 that we figured the first way, that's the advancers to the decliners, and you divide it by the volume of the advancers to the decliners, which was, the ratio there turned out to be 2.3. So 1.7 divided by 2.3 is 0.74. So that was a very strong up day. A lot of advancing stocks, quite a bit of volume. You can see we got a low number. You got a 0.74. And what that tells you is that day the market was somewhat overbought. All right? Because you got a number less than 1. Now let's take a strong down day, and we just flip these numbers. Instead of 1,900 advancers and 1,100 decliners, let's say it was the other way around. You had 1,100 advancers and 1,900 decliners, so the ratio came out to be 0.58 there. And the volume was just flipped around as well. The volume on the advancing stocks was 600 million, and the declining stocks volume was 1.4 billion. So the ratio there came out to be 0.42. So on that day, you had a lot of stocks going down on quite a bit of volume. You came up with a number of 1.38. See how it's higher than 1? So, you went down that day, but as an indicator, what it's telling you is you're a little oversold by doing that. And if you string 5 of these examples that I just gave you, either 5 of those 0.74 days together, you have a market that has a 5-day total that's telling you it's very overbought. And if you string 5 of those 1.38s together, you have a number that's well over 6 that's telling you that we're oversold. Okay, so that, and it's a short-term indicator. All it tells you is on the short term you're either overbought or oversold. If you're going up, in the first example I had, a lot of stocks going up with quite a bit of volume on a relative basis. You might pull back for a day or two and then continue to go up. It's not telling you what the trend is. It's just telling you the short-term likelihood, the short-term probability. So we can use that indicator to our advantage. And here in this little example, I've got the current 5-day ARMS total. And the current 5-day as we come in today is 4.45. And they're all numbers less than 1 except for the 3 days ago when we had the Tuesday, September 7th number of 2.02. And we come up with a number that's around 4, but one day accounts for 2. So you can tell how low those other numbers are. And what that tells us is right now we are overbought, but if we get numbers like we did the last 2 days. The last 2 days we got a 0.8 and a 0.76, so we're averaging around a 0.8. So if we get some 0.8s the next couple of days, we're going to drop off a 2. This number is really going to take the market to a low number or a very overbought situation on Tuesday, after Tuesday of next week. Okay, that's the 5-day. Now I've got the 10-day. And the 10-day arms is the exact same thing. It's just, a string of 10 previous days here. And that total turns out to be 11.7. Now, I had told you before that a 10 plus or minus was kind of neutral. And this is somewhat neutral. But again, our eyes go to that 3.8. We talked about the 10-day arms. Now, the 5-day arms is what I use most of the time, but I always keep my eye on the 10-day arms. And if you can get the two of them to agree and give you the same conclusion, that's 2 nods of the head instead of 1. That's more powerful as an indicator. Now, one way to use that 10, a lot of people do this. It's not necessary. You can use the totals. But a lot of people will take the average of the 10 days, which is just taking that previous rating that we had there. The previous calculation I had was around an 8. We're going to wind up close of business Tuesday with around an 8 if we get next 3 days with 0.8s on the arms. Okay. Now here's a little chart that I have out for the folks in the den. This happens to be the NASDAQ. You can do the TRIN indicator as a TRIN based on NASDAQ advances, decliners, and volumes. S&P, Dow, New York Stock Exchange, etc. You can do it on any of the markets. This one does it on the NASDAQ, and it just divides the 10-day total by 10. So a 0.8 is the same kind of number that we have coming up maybe next Tuesday. Here's one that shows 2008. We had a 0.8 around May of that year. We didn't get a big decline. We had another 0.8 though around August of that year, and that was the tell that told us we got the big decline, and the NASDAQ made a huge 1,000-point drop between roughly September and December of 2008. So does it always work? No, it doesn't always work, but it did. For instance, in this example that I've got here around September of 2008, it's a great example of indicators and how they can be powerful tells on the market.
Are you tired of chasing after the crowd and getting into stocks with no real plan? Start getting advice that works for you. Let Bud Rolfs, Chief Technical Analyst of the Tiger Trading Post at TFNN.com, be your personal guide through the jungle that is the market. Bud offers personalized and customizable programs for investors who are serious about making and saving money in the market. Find Bud Rolfs and the Tiger Trading Post under the advisory services at TFNN.com today and get the personalized investing advice you deserve.